Everyone thinks SpaceX is a Mars company focused on interplanetary life, and they think the IPO is their chance to buy into the future. But the reality is a lot darker. SpaceX isn't really a rocket company anymore. It's becoming a massive data and surveillance empire, with Starlink funding the rest of Elon Musk's ecosystem. After the February 2026 merger, xAI and X both sit inside SpaceX as wholly owned subsidiaries, which means every dollar raised by the IPO can flow straight into the parts of the empire bleeding cash. Your retirement fund might be bankrolling a company that sells rockets to the public while building something far bigger behind the scenes. On May 20th, 2026, SpaceX filed its S-1 with the SEC under the ticker SPCX. The company was targeting a $1.75 trillion valuation and looked to raise $75 billion when pricing began on June 11th and trading opened on June 12th. It was the largest IPO ever attempted. Alibaba's record-breaking 2014 listing raised $25 billion. Saudi Aramco raised $29 billion in 2019. SpaceX is aiming for nearly 3 times that size. But the real danger isn't the IPO itself, it's what comes next. Vanguard, BlackRock, and State Street are sometimes called the Big Three. That nickname barely does them justice. Together, they control about 75% of all U.S. ETF money. Today, roughly 1 out of every 4 shares in the average S&P 500 company sits inside a passive index fund, up from just 1 in 14 a decade ago. When a massive company joins the S&P 500, those funds don't stop to think about it. The systems are built to buy automatically. There are no board meetings or approval process. The money just starts flowing. With SpaceX hitting a $1.77 trillion valuation, some analysts expect between $250 to $300 billion could flood into the stock within the first year alone. And that money isn't coming from venture capital firms. It's coming from you. From your 401k, from your IRA, from your state pension if you have one. About 60 million Americans own target date or total market funds, and most of them will never even realize they bought SpaceX. The trade will happen automatically in the background. For scale, $300 billion is about what it would cost to buy every NFL and NBA team combined. It is more than the GDP of Portugal. It's bigger than the annual budget of the United States Navy. The dot-com peak in March 2000 happened when tech made up about 33% of the S&P 500. By early 2026, Microsoft, Nvidia, Alphabet, Meta, Amazon, and Apple alone already pushed past that level. Now add a $1.77 trillion AI-powered company on top of that. The chart blows through every historical warning sign ever drawn. And if this IPO is really some kind of rescue operation, the obvious question is, who is actually being rescued? Because it's not the rockets. It's a social media platform that Musk bought in 2022, one that reportedly lost around 30% of its US daily users in just a few years and is still bleeding ad revenue, which means millions of people may end up involuntarily bailing out a business they never even intended to invest in. In October 2022, Elon Musk dropped $44 billion for Twitter and then quickly renamed it X. The deal closed with $13 billion in loans from 7 banks, with Morgan Stanley leading the group. The plan was simple. The banks would sell those loans on to bond investors, collect their fees, and then move on. Except that plan fell apart fast. The Federal Reserve raised rates harder than anyone had modeled. Money got expensive overnight. Ad dollars pushed back, Disney cut spending, Apple paused, IBM reduced exposure. Suddenly, buyers on Wall Street didn't want the platform at full price anymore. The Wall Street Journal called it the worst buyout debt deal since the 2008 crash. In February 2025, Morgan Stanley sold $5.5 billion of Senior X loans at 97 cents on the dollar. PIMCO, Citadel, and Apollo picked them up. The banks got out almost whole, but the debt itself didn't vanish, it just changed hands. The interest bill on what's left runs over $1 billion a year. That works out to about $3 million every single day. Before the merger with xAI, that was already more than X could cover from advertising revenue alone. And that's the key detail most people miss. Because inside the empire, not all businesses were allowed to help each other. Starlink and Starshield generated cash. Even Falcon 9 launches brought in steady revenue, but none of it could legally flow into X. Each company sat behind its own corporate wall. That wall held until February 2026. That's when SpaceX absorbed xAI in an all-stock deal. The press release talked about the future of AI in space. There were all the usual buzzwords about putting compute next to satellites. But the real effect was consolidation, a sleight of hand. XAI had already taken control of X the year before, so when XAI folded into SpaceX, the debt and obligations moved with it. The entire chain of liabilities landed on the only balance sheet large enough to carry it. SpaceX entered the deal valued at about $1 trillion, XAI at roughly $250 billion. Together, that puts the combined private valuation at $1.25 trillion. The IPO was being pitched at $1.75 trillion. That's a 40% jump on top of a merger structure the public market never signed off on. But not everyone sees that as a true reflection. Scottish Mortgage Investment Trust, a respected UK growth fund and long-term SpaceX backer, has the company at roughly 19.3% of its entire portfolio, but it still values that stake at about a $1.25 trillion company. That's roughly $500 billion below the IPO ask. These are not short sellers or Musk critics. It's one of the most committed holders in the business, and they think the IPO is overpriced by about 40%. So the listing isn't about raising fresh cash for Mars. It's about turning a pile of private debt into a stock that index funds have to buy. The trick only works if the US government has nowhere else to turn for rockets. And that's the trap Musk spent the last decade setting. For about 60 years, the Pentagon had one rule when it came to space and missile work: never get stuck with one supplier. Boeing competed with Lockheed. Lockheed competed with Northrop. Raytheon, now RTX, kept everyone honest when it came to prices. That rule has been shattered. By late 2025, SpaceX was launching most U.S. national security satellites, and the trend has only sped up. United Launch Alliance, or ULA, is the Boeing and Lockheed joint venture that used to dominate the business, but now ULA has become a minor player. Its new Vulcan rocket flies a handful of times each year. Falcon 9 flies more than once a week, sometimes more than once a day. In 2024, SpaceX won 10 of the 21 national security launch contracts. ULA won the other 4. Northrop's Antares rocket walked away with nothing. Blue Origin, the Jeff Bezos rival, holds contracts but is still finishing its certification flights. Boeing's troubles run even deeper. The Starliner crew capsule keeps slipping schedule. NASA paid Boeing $4.2 billion to build it, but the first crewed test in June 2024 ended with 2 astronauts stuck on the space station for 9 months. SpaceX Crew Dragon had to bring them home. It's a reminder of how concentrated the high end of this industry has become. Take the 5 biggest U.S. defense contractors: Lockheed Martin, RTX, Northrop Grumman, General Dynamics, and Boeing. Add their market caps together, and you land somewhere around $600 to $700 billion on a strong trading day. Now compare that to SpaceX's IPO. One company is worth about 2.5 times the traditional U.S. defense industry combined. When the Pentagon needs a satellite in space immediately, there's no backup option. There is no second vendor waiting on the launch pad. When the prices go up, the Pentagon pays. When a launch slips, the Pentagon waits. That isn't a normal customer relationship anymore. It's closer to the sole supplier with all the leverage on one side. But the rockets are only half of the story. The real money is what sits on top of them. According to astronomer Jonathan McDowell, there are nearly 10,300 working Starlink satellites in orbit as of May 2026. That number is so lopsided it sounds wrong. Add up every other satellite in space and it doesn't even come close to what one private company owns by itself. This isn't a broadband network anymore, it's the backbone for things that most people never even think about. The US Army runs Starlink terminals in Ukraine, more than 50,000 of them across the country at the last public count. Royal Caribbean offers fast Wi-Fi on its cruise ships through it. Maritime shipping companies use it to route container traffic. Starlink pulled in $11.4 billion in revenue during 2025, with $4.4 billion in operating income. That cash now subsidizes the rest of the empire. xAI's Colossus data center in Memphis runs 200,000 NVIDIA H100 chips. Each chip costs around $30,000. That puts the hardware bill near $6 billion before anyone turns on the electricity. And despite the scale, xAI still lost about $6.4 billion in operating during 2025. One of the only consistently profitable parts of the empire is now indirectly supporting one of its most expensive. The deeper problem is that nobody can police this. The satellites cross 164 borders every day at 17,000 miles per hour. The FCC can pull a US license, but then the ground stations just move to Cape Verde or Singapore. And the EU can find the local arm of SpaceX and they can just shuffle the paperwork. AT&T owned the US phone network until 1984, when the government broke it up. It operated inside a single country where the courts could reach it. SpaceX operates above all of them at once. There isn't a courtroom on Earth with the right address. The premium would be fine if the hardware worked the way the IPO paperwork claims, but it doesn't. The current Starlink workhorse is the V2 Mini. It was claimed it could deliver 4 times the bandwidth per satellite, but the reality has been more complicated. Tracking data from Jonathan McDowell and KeepTrack shows the full picture. Out of roughly 11,600 Starlinks launched so far, more than 1,500 have already deorbited. Some were planned retirements, but many weren't. Several V2 Mini batches have run into thruster problems and fuel leaks. The failures forced them out of orbit early, sometimes within months of launch. SpaceX has owned up to the issue in FCC filings, but the filings stop short of putting a number on it. Each early death costs the company twice. First, the satellite stops earning subscription money. Second, the next Falcon 9 launch has to replace the dead unit, instead of expanding the network. That's a real problem for a network that needs to keep growing. The $1.77 trillion price tag demands it. In early 2026, SpaceX lowered the main band of Starlink satellites from 340 miles above Earth to roughly 300 miles. On paper, it's a safety move. Lower orbits reduce collision risk and they make it easier for dead satellites to burn up in the atmosphere. But there is a hidden cost. Every satellite already in that layer has to fire its thrusters just to move down into the new altitude. That burns fuel immediately, which means less fuel left for keeping position over time and shorter operational lifespans. That shows up later in how often satellites need replacing and how fast the network ages out. It's like a car maker shipping a model where 1 in 7 units has an early engine problem. Some get fixed, some get replaced, the line keeps moving, but the bill adds up and so does the reputation hit. It's the safety aspect that's concerning. The FAA tracked 8 close calls in 2025 alone. Each one was a Starlink satellite passing within half a mile of another spacecraft. Hundreds of warning alerts go out every week, and SpaceX's collision avoidance system handles most of them. Most. The one it eventually misses turns into what astronomers call a Kessler problem. A single collision throws off a cloud of debris, which hits more satellites, which then throw off more debris, and the chain reaction never really stops. Low orbit becomes useless for a generation, taking weather satellites and GPS with it. With debt stacking up and hardware issues showing up in the system, the listing needed something else to carry the weight. Something without clear revenue yet, but with enough momentum that markets would still assign it a premium. So AI stepped up. The February 2026 merger turned xAI from an independent startup into a SpaceX-owned company, all in the span of a single press release. The deal was all stock. Each xAI share was converted to SpaceX shares, and SpaceX was valued at about $526 per share, and xAI roughly $75. No cash changed hands. The press releases skipped one crucial detail. Less than a year before the merger, Musk hired Sullivan & Cromwell to independently value xAI. Their figure came back at around $80 billion. By the time the merger closed, the board had marked it at $250 billion. The same company and assets, but a different number. What changed during those 11 months? Well, not much, frankly. There was no new product worth naming or fresh revenue streams. Grok 3 launched in February 2025, with Grok 4 following later. Neither came close to OpenAI's revenue or Anthropic's enterprise sales. ChatGPT alone hit $4.3 billion in revenue in the first 6 months of 2025. Anthropic's overall valuation cleared nearly $30 billion by spring 2026. Grok pulled in a fraction of either, with paid subscribers below 5 million against more than 59 million for ChatGPT. The xAI valuation went up because the IPO needed it to. The reason this works comes down to how different parts of the market are priced. A satellite business might trade at around 6 times revenue. Anything tagged as AI can trade at 40 or even 50 times. So if you fold in an AI company to a satellite company before it lists, you don't just add revenue. You potentially change how the entire package gets valued. That's the logic behind putting xAI inside SpaceX before the IPO. One group of analysts calls it stacking. Others use a less polite word for it. The Motley Fool, a retail investing and financial advisory site, ran the numbers in March 2026. The S1 shows about $18.7 billion in combined 2025 revenue across SpaceX and xAI. At a $1.77 trillion valuation, that implies a price-to-sales ratio near 94. For context, Cisco peaked at about 38 times sales during the dot-com bubble in March 2000. After that, the stock fell roughly 86%, and took 25 years to reclaim its old high. SpaceX is priced at more than double that peak. So how did the regulators let this happen? You might expect a smoking gun here, a senator on the payroll, or a specific rule written in the dark, some clean villain to point at. There isn't one, and that is worse than the alternative. Over the past decade, U.S. exchanges have been losing big listings to Hong Kong and Saudi Arabia. Industry lobbyists pushed hard for changes to bring those listings back. Each change sounded reasonable on its own. Shorten the review window, loosen a float requirement, and speed up disclosure. Each change sounded reasonable all on its own. Nothing dramatic, just incremental adjustments one after another. Nobody ever voted on a SpaceX bill. The rules just got easier one footnote at a time. S&P Dow Jones indices run its own fast track for the largest IPOs. Snowflake and Airbnb got in fast. The old rule was straightforward. A new company had to trade publicly for a full year before joining the index. That gave analysts and short sellers time to find any problems. That rule has been bent so many times it barely even exists anymore. SpaceX booked $18.7 billion in 2025 revenue alongside a $4.9 billion net loss. Under the old rules, a name losing that much would never get fast-tracked, but under the new ones, it might slip through. Politics played a part too. In early 2025, the administration set up an informal national interest review track at the SEC. It was aimed at companies tied to defense and AI. Reviews were faster and questions were softer. The agency would never call it a rubber stamp because on paper it isn't one. The auditor side is just as strange. SpaceX is audited by PricewaterhouseCoopers, who also audits Tesla. These are two companies that swap assets, employees, and contracts every quarter. None of that breaks any rules, but overlapping corporate ecosystems at this scale tends to make regulators uneasy, not because of anything illegal on the face, but because complexity itself becomes hard to track. And there's a reason that unease exists. The firm was Arthur Andersen, and the client was Enron. Enron was the seventh largest company in America until it wasn't. A bankruptcy event wiped out $74 billion in shareholder value. Pension funds lost hundreds of millions. 22,000 employees lost their jobs. 6 months later, Andersen was indicted. A year after that, the firm shut down for good. Layer it all together and the result is a single company in a single filing bundling defense, satellites, AI, and a social network into one public ticker. Index funds don't get to choose. If it's in the index, they have to buy it. Nobody designed that outcome. It emerges anyway, the way most systemic problems do, in small steps that no one notices. The bell rang on June 12th. What comes next is the part people will remember. SpaceX's IPO seems like a natural progression for the company, but if you want to understand the man at the center of it all, watch The Ugly Truth About Elon Musk, or click on this.